This John Lothian News video is sponsored by
Pro Opticus, professional derivatives trading and risk management software solutions.
Clearinghouses are now considered systemically important to financial markets, but with that designation come new regulations and capital requirements. John Lothian News sat down with Kim Taylor of CME Clearing to talk about how a new requirement will raise costs for market participants.
The CFTC Reg 3933 is part of the regs that they need to put in place by the end of the year in order for U.S. clearinghouses to be QCCPs and qualify for improved capital treatment under Basel III. Basically, the rules need to implement a set of international standards called the PFMIs, and one of those standards is regarding liquidity. The standard says that sovereign obligations, Treasury securities, are considered part of the liquid resources that a clearinghouse must hold to cover the worst case loss of its single largest participant. In other jurisdictions, clearinghouses can count government securities as liquidity, but the Fed has an interpretation of highly reliable and prearranged. That means that they're saying we have to have a committed line of credit or the equivalent type of facility to back up Treasuries dollar for dollar. So basically, no credit for Treasuries as a liquid resource. A couple things could happen. Clearinghouses could change their policies around the acceptance of Treasury securities. Clearinghouses could seek larger bank lines of credit, which is, I think, the outcome that the Fed is steering people toward. But at the same time, there are interactions with other Basel regs, the capital regs that affect banks, that basically say instead of historically, banks could issue lines of credit less than 1 year and there wasn't a capital impact. Now the capital impact of those lines is going to be calculated as if the lines were fully drawn, which is going to make the cost for banks of issuing lines of credit much, much higher, and therefore going to ration the capacity. So at the same time, the regulators are saying banks don't lend, regulators are saying clearinghouses get more bank lines, and it will raise the cost of doing business in some way. We have some freedom to decide in which way, and we're trying to work with the clearing members to come up with the kind of the least adverse impact on the way to address this issue. But ideally, we would be able to influence the U.S. regulators to interpret the international standard the way the Aussies, the Singaporeans, the Europeans, and the Bank of England, as a specific example of the Europeans, has been very vocal on the issue that government obligations are a much better source of liquidity than bank lines.